Welcome to JM Financial Mutual Fund's Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the month gone by. We will also share our views on the domestic fixed income markets, which could, in turn, impact the positioning of our schemes. Global bond yields increased significantly in October 2024. 10-year benchmark United States Treasury, after softening in August 2024 and September 2024, retraced to the July 2024 levels of 4.30, whereas benchmark yields of 10-year German Bund and 10-year Japan bond hardened by 29 basis point and 8 basis point, respectively, during the month. The U.S. economy in October 2024 faced a reversal in sentiments and Treasury yields following better-than-expected labor market data. The United States Treasury yields hardened across the curve, with 2-year, 10-year and 30-year yields moving up by 54 basis points, 51 basis points and 36 basis points respectively. Though the Fed FOMC meeting minutes for September 2024 highlighted the need for a gradual policy normalization as inflation continuously drifts closer to the target of 2.0%, the labor market data made the markets rethink about the likely path of the interest rates in the U.S. going forward. Also, uncertainty pertaining to the U.S. elections kept the markets a little edgy. Inflation indicators continued to show a downward trend. CPI inflation moderated to 2.4% year-on-year in September 2024 from 2.5% year-on-year in August 2024. PCE inflation, Fed's preferred inflation gauge of inflation, moved lower to 2.1% in September 2024. From 2.3% in August 2024. PPI also declined to 1.8% year-on-year in September 2024 from 1.9% year-on-year in August 2024. Growth. The U.S. economy grew by 2.8% quarter-on-quarter SAAR in Q3 2024. Expectations -3%. Lower than previous quarter's growth of 3.0%. Decline in U.S. GDP was led by slower gross private domestic investment. Flash estimate for manufacturing PMI for October 2024 continued to remain lower than 50 level at 47.8, however marginally better than the previous month's reading of 47.3. Services Purchasing Managers Index remained strong at 55.3 in October 2024, as per flash estimates. Retail sales for September 2024 increased by 0.4% month-on-month from previous 0.1%. Expectations -0.3%. Labor. The non-farm payrolls climbed to a 6-month high of 254,000, and unemployment rate moderated to 4.1% in September 2024. Continuing jobless claims decreased to 1,862 from 1,888,000 previously. Similarly, initial jobless claims decreased to 216,000 versus expectations of 229,000. Average hourly earnings grew by 4.0% year-on-year, highest since June 2024. On the other hand, new job vacancies, as captured in job openings and labor turnover survey, showed a moderation at 7.44 million in September 2024, down from 7.86 million in August 2024. Eurozone. The European Central Bank, ECB, cut the policy rates by 25 basis points for the third consecutive meeting, bringing the deposit rate and main refinancing rate to 3.25% and 3.4% respectively. The ECB remains optimistic about the disinflation process, however has refrained from pre-committing to a particular rate path. Canada. The Bank of Canada reduced policy rates by 50 basis points in line with expectations to support its economy as inflation is poised to head lower. Japan. 10-year Japanese government bonds hardened and closed at 0.94% in October 2024. Yen depreciated above 150 levels in the second half of October, 2024 after being below 150 levels for the previous 2 months. Bank of Japan kept interest rates unchanged at 0.25% in October 2024, though there are expectation of one more rate hike in 2024, possibly in December 2024. The effects on the global markets could be cascading with another round of carry trade unwind. The monetary policy divergence of US and Japan will be a key risk for global markets. We remain watchful of the developments as Japan is one of the largest holders of United States Treasury, UST, and the interplay between US dollar per Japanese yen, 10-year Japan benchmark and 10-year UST continues to provide uncertainty on global rates. China. Growth momentum in China continues to moderate. People's Bank of China continues to cut interest rate in view to support the economy. China's economy grew by 4.6% year-on-year in Q3 2024, down from 4.7% recorded in Q2 2024, reflecting soft private demand and headwinds from the property sector. On the other hand, China's Manufacturing Purchasing Managers Index, PMI, printed above 50 levels at 50.1 in October 2024, first time since April 2024. China will expand its whitelist of real estate projects and speed up bank lending for the unfinished developments to 4 trillion Chinese yuan, US dollar 561.8 billion, by the end of the year, the country's housing ministry announced in October 2024. The 10-year GSEC traded in a band of 6.73% to 6.85% and closed at 6.85% in October 2024, vis-à-vis 6.75% in September 2024. Yields of 91-day T-bill, 182-day T-bill, and 364-day T-bill hardened by approximately 11 basis point, approximately 9 basis point, and approximately 5 basis point, respectively. Indian benchmark bond yields were higher broadly by 10 basis points during the month. In tandem with United States Treasury UST yields which drifted higher, 10-year Irish government bond reached 6.83% levels at the start of month. RBI changed stance to neutral from withdrawal of accommodation, which led to benchmark yields settling at 6.77% levels. Towards the end of month, benchmark yields moved in loose synchronization to UST yields to close at 6.85% levels. CPI inflation rose to 5.49% in September 2024 from 3.65% in August 2024. The reading also came in higher than the Bloomberg's median poll of 5.10%. The year-on-year reading increased from 3.65% in August 2024 to 5.49% in September 2024, led by a sequential increase of 62 basis points along with an unfavorable base of approximately 113 basis point. Food and beverages inflation sharply rose to 8.36% in September 2024 from 5.30% in August 2024. Vegetables observed higher inflation of 35.99% in September 2024, an increase from 10.75% in August 2024. The year-on-year reading in vegetables increased due to a strong unfavorable base, along with a sequential uptick. On a sequential basis, vegetable prices climbed by 3.49% in September 2024 compared to a decline of 2.47% in August 2024. In September 2024, the CPI ex-food and beverages stood below 4.0% at 2.88% for the 13th consecutive month. Core inflation surged slightly to 3.50% in September 2024 from 3.40% in August 2024. Transport and communication jumped to 2.77% in September 2024 from 2.71% in August 2024, highest in the last 18 months. Also, Personal care and effects noted a higher inflation of 9.00% in September 2024 compared to 8.00% in August 2024 due to a sharp increase in gold and silver prices. During October 2024, US dollar USD traded with a strengthening bias and appreciated by approximately 3.17%. Better than anticipated labor market data led to markets assessing the likely path of the interest rates in the US. While US dollar appreciated during the month, all the key currencies noted a depreciation, especially Japanese yen, which crossed the critical 150 mark in mid-October 2024. Indian rupee INR depreciated by 0.34% in October 2024. INR traded in the range of rupees 83.82 to 84.09 per USD during the month and ended the month at rupees 84.08 per USD. FPIs were net sellers in both equity and debt markets in October 2024, with outflows of rupees 94,017 crore and rupees 4,406 crore, respectively. Forex reserves stood at $684.8 billion as on October 25, 2024, compared to $704.9 billion a month ago, noting a decline of $20.1 billion during the month. Liquidity conditions during October 2024 improved, aided by higher government spending. Daily average liquidity surplus increased to rupees 1,50,012 crore in October 2024 from a daily average surplus of rupees 1,916 crore in September 2024. The daily average of weighted average call rate stood at 6.50%, lower than the September 2024 month's average of 6.56%. Bank deposit growth stood at 11.7% as on October 18, 2024, surpassing the bank credit growth of 11.5% for the first time since April 2022. On a FYTD basis, bank credit grew by 4.9% compared to a growth of 13.1% in the corresponding period of the previous financial year. On the other hand, on a FYTD basis, deposit growth grew by 6.5% compared to 8.2% in the corresponding period of the previous financial year. Momentum in credit growth has slowed, which is also reflected in the declining credit deposit ratio. The economic indicators continue to show a mixed picture, especially with strong indicators such as robust GDP and retail spending. The latest labor market data also indicated strength. On the other hand, inflation seems to be on a downward trajectory, supporting the Fed's dovish view. It remains to be seen whether the Fed would deliver the estimated 50 basis point cut in the remainder of the current year or not. Key monitorable remains from developments in China as well as Japan over the medium term. China would be expected to have support both from monetary but, more importantly, fiscal side to get its house back on track. The resultant impact on commodity cycle upturn may be a development to be watchful of, especially for import-dependent nations like India. Japan, on the other hand, may be on a rate hike journey, and the resultant impact of unwinding of yen carry trades on various asset classes could be another important monitorable. While domestic inflation is susceptible to volatility due to food components, continuance of resilient domestic growth necessitates no rush for softening in interest rates. However, certain high-frequency indicators in the past few months have shown some signs of moderation. However, foreign capital movement away from Indian markets, equity and debt, and to better valued China markets have kept the Indian rupee under pressure. FPIs were net sellers in the domestic debt markets in October 2024 after being heavy buyers since April 2024. Nonetheless, IGB's inclusion in the third global index would help keep the demand-supply dynamics favorable. Also, the new LCR norms by the RBI would keep the demand side of the equation well supported. Also, the government's intent to be fiscally prudent could act as one of the key positives for the domestic bond market. The government aims to bring down fiscal deficit below 4.6% by FY 2026.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.